Good evening and welcome to Africa Business Weekly, your wrap of the top business stories from across the continent. I'm Karabo Mashaba, and coming up on the show today, we take a closer look at how underinvestment in Africa's value chains is slowing progress on intra-regional trade and what that means for the continent's economic integration. Then we get insights from Moodys, who recently upgraded Nigeria's rating, citing easing inflation. Of course, I'm not alone. I'm joined by my colleagues David Alabi and Abi Agina. But let's head over to Lagos, where David will take us through the key business news in West Africa this week.
Hello, Karabo. Now, from our West African desk, Moodys rating says Nigeria's inflation and domestic borrowing cost is showing nascent signs of easing, bolstering confidence in the stability of ongoing policy changes. While Lucy Villa, the senior vice president at Moodys, says the significant improvements in the country's external and fiscal positions are the rationale behind the country's ratings upgrade to B3, and expects the recent progress on the external and fiscal fronts to continue, though at a slower pace if oil prices fall further.
The rationale, as you call it, the reason why we decided to upgrade the rating for Nigeria is based on three main considerations. The first one and the most important one is the improvement in the external buffers that Nigeria has managed to do in the last 2 years, thanks to varying reforms. But the most important one has been the overhaul of the Forex market in Nigeria. The second driver is more related to the fiscal policy and what the Ministry of Finance has managed to achieve in terms of trying to bring in more revenue and trying to, of course, cut the spending. One very important measure has been the removal of the oil subsidy, which, depending on the year, used to cost almost 2% of GDP to the budget. And the last driver is more related to the degree of comfort that we get around the inflation path and the interest rate path. A big concern for us had been when the authorities started to implement these two reforms, oil subsidy removal and the new Forex market with the FX rate really determined by market forces. Our main concern was the inflation shock that it would create, and these measures did create a very large inflationary shock. But we're seeing since the beginning of 2025 first signs that inflation pressure is easing. And with that, we're also seeing the very beginning, very nascent signs of normalization in interest rates, especially if you look at the interest rate at which the government borrowed since the beginning of the year, we started to see the first decline.
And talking about this nascent signs of easing when we are talking about inflation and domestic borrowing costs, now I'd like us to narrow down just a little more into the likely case scenarios where you hinge the expectation on the stable outlook for the near term. Now, if we're expecting progress on the external and fiscal fronts to continue, though at a slower pace, considering the fact that we still have low oil prices at this moment, how much wiggle room does the country have to maneuver through some of the headwinds? We have the concerns around the U.S. moves and even looking at OPEC's decision to continue with its output increases.
Yeah, there are external developments that have been, very important for Nigeria. What is interesting is that, a lot of the measures that have been discussed has been really domestically driven. But then there has been this more challenging trade environment, and in particular, the lower oil price that this has generated. And to us, really, what this has done is remove a bit of the upside risks that we would have seen otherwise. If this development had not happened, probably we would have seen more further prospect of improving down the road. Because of this environment, we think it's removing some of the upside risk. So our baseline scenario, and the one really explaining why we have a stable outlook on our B3 rating, really rely on the expectation that the improvements that we've seen on the external front and on the fiscal front over the last 2 years will not continue at the same pace.
In company news now, South African diversified financial services provider Sanlam and German multinational financial services provider Allianz have signed a significant milestone in their Pan-African expansion strategy with the successful merger of their operations in Nigeria. The merger, now branded as Sanlam Allianz Nigeria, was officially announced this week. And Tunde Mimiko, the MD CEO of Sanlam Allianz Life Insurance Nigeria, and Yomi Onifade, MD CEO of Sanlam Allianz General Insurance Nigeria, share more insight on their expansion strategy.
Allianz decided to look for partners in Africa to continue to service their multinational clients. They found Sanlam as the most suitable partner. And why is that so? Sanlam is the leading non-banking financial service institution in Africa with footprints in over 27 countries in Africa. We do consider that the values of the two organizations do align, and there was no other partner to go with but the leading brand in Africa, joining with a global leading brand as well. So this is a unification of two giants that is now here for Nigerians and is being driven for Nigeria to provide value to Nigerians for the benefit of growth in the economy of Nigeria.
Yomi, I'd like to go to the impact that you're looking to make, especially in the general insurance space in Nigeria, looking at how the market here has developed.
Thank you very much, and thanks for having us today. In terms of impact within the Nigerian market, the first important thing was to build an institution with a bigger balance sheet size, stronger financial muscle. We've seen devaluation of the currency present us with a unique challenge where a lot of the factories, a lot of assets locally have more than doubled in Naira valuation, not so necessarily in FX. Again, we have the problem where all claims are literally serviced by inputs being imported into the country for to either upgrade or repair factories and plants when they do break down. So very important to have institutions locally that can help to retain premiums in local markets as driven by the regulator, NICOM, and also to be able to provide that financial security and support to our customers.
Let me get to Tunde now to get the perspective for the life insurance and the impact you're also looking to make in that space.
In the life insurance space, we believe that with the competitive advantage of our population in Nigeria and having over 100 million adults that are also very digitally savvy, there's that huge opportunity to deepen insurance penetration, and by so doing, support the government's agenda for financial inclusion to impact growth in the economy. So for us, we will be deploying different solutions that will make insurance accessible to everyone, because at Sanlam Allianz, we do believe that everybody has the right to be serviced anywhere and anytime. So we'll make insurance accessible and we'll make it affordable.
Because we know that with insurance, it's all about product differentiation and how you're appealing to the market there. And I'd love to get your take on that and how you're looking to service this market.
Well, the benefit of being in 27 countries and potentially more is that we're able to leverage on solutions that have worked in other markets to help develop the Nigerian market. Of course, you don't do a copy and paste approach. You have to localize all solutions, which is why within the Nigerian business, for example, the business is run by Nigerians for Nigerians. So we're able to leverage on the best of resources from both the Allianz end and the Sanlam end to provide solutions that work for Nigerians within this market.
Well, that's it from me. It's back to you now, Kirabo.
Thank you for that update, David. Now let's shift gears and head over to East Africa. It's over to you, Abby.
Hello, Karabo. Trust you're well and keeping warm down south. From the east side of Africa, it has been awash with big conversations around trade and some new rules at the Dar es Salaam Stock Exchange. Investment gaps within Africa's value chains continue to hold back the continent's ability to increase intra-regional trade. Well, I spoke to Doug Willem de Valde for more.
We all know that in conceptual terms, the AFCA has tremendous potential for kickstarting more intra-Africa trade and more investment on the continent. But everything hinges on implementation. And so we assembled a range of key institutions, particularly African institutions, but also some others, on this topic about implementation of the various protocols of the African Continental Free Trade Area. And so we had, of course, important contributions by the AFCA Secretariat itself. And whilst it had focused very much on the negotiations of various protocols, including the protocol investment, it was now also focused on implementation. And so thinking about how it could help to support member states, state parties that have signed up to the investment protocols and the other protocols of the AFCA and how to implement these. We also had a range of presentations and introductions by a number of key institutions, such as the Trademark Africa, a flagship Aid for Trade project in Africa, and also ODI Global. And sort of the ODI representative really talked about the importance of the collaboration between the AFCA Secretariat and ODI and state parties to undertake so-called investment gap analyses, where we really think through what countries are already doing in the area of investment protection, investment promotion, investment facilitation, what their investment codes already are, and what they have signed up to with the African Continental Free Trade Area Protocol on Investment. And so think about what are the gaps. And in this context, have already supported more than 15 countries. Trademark Africa was able to discuss a range of areas on trade facilitation. So they've been supporting member states already for quite some time in the area of trade facilitation, custom clearance, and sort of the nitty-gritty of work. We also had the African Development Bank itself chipping in, arguing that it had already been with member states for quite a long period of time on following the objectives of the AFCA and really helping countries to work on the supply side, helping them to build appropriate and good quality infrastructure that could help them to both produce better quality products, but also help them to trade across borders. And then we also had member states' views on the AFCA and its protocols and how does it look from their perspective. And so we had a representative of the Gambia really talking through what he was already looking at, and it was looking at special economic zones. It was looking at gazetting its new tariff concessions for other state parties to the AFCA. But it was now also undertaking, with the support from the AFCA Secretariat and ODI, an investment gap analysis between what is already in its investment code and what is in the protocol investment that it had signed up to with the AFCA. And so they were then thinking about these differences and then drawing up an action plan, and then they're now in the final stages of updating their investment code, and they were also updating it in a way that aligned them more with the protocol on investment.
The Dar es Salaam Stock Exchange is showing resilience as new trading rules come into play, with steady equity activity and a strong bond market performance. Isaac Lubeja, Advisory and Research Manager at Zan Securities Limited, spoke to Tabitha Mudhoni for more on how the market is reacting.
Big key developments in the market, and so far we're seeing that there have been new operational guidelines as far as trading is concerned, and they just rolled out on Monday, 2nd of June, The effect of that we're seeing in the market is there's more price discovery and more liquidity in the market. So you have counters that have been, so to speak, stuck for a very long time, begin trading. Example, you have Vodacom. Vodacom has been at the same share price at 770 since 2020. But since Monday, when the new trading rules came into operation, Vodacom has changed 10%. So we're seeing that there's going to be lots of liquidity in the market for counters that have received little to no flows. And we're going to see a lot of price movements in the coming weeks ahead. So, the market is very optimistic about these new rules because they create more leniency and they allow market participants to get a broader participation of the market.
And also, Isaac, we are seeing a notable surge in foreign investor purchases compared to domestic activity. So what do you think is really driving this renewed confidence in Tanzanian equities, and how sustainable is it?
So generally, what we're looking at in the market, we're seeing valuation re-rating, which has caused a lot of interest from foreign frontier funds to invest into the market. More notably, we're seeing flows coming into counters such as TBL and TCC, consumer counters, of which they've declared historical high dividends. For example, TBL has just declared a full year dividend of 818 shillings per share. And TCC has declared 850 shillings, which basically these have been a catalyst for the inflows that we're seeing from foreign funds. So basically, our outlook or our assessment of the market, we are very much poised to seeing more inflow. And when we look at the data suggests that so far this year, in the 5 months of 2025, there's been more than 28 billion Tanzanian shillings in terms of buying interest from foreign funds compared to the 14 billion that was registered in the entire year of 2024. So that gives you a picture of how positive the market is poised to be throughout 2025. So this has been a very huge development in the market.
So definitely a diversification you're seeing there, looking at a local, institutional, and also retail investors returning to the equity market. But I am keen on the bond market. Can we say the new rules have impacted the bond market? Because looking at the numbers here, we are seeing over 52 billion Tanzanian shillings traded just across 20 deals here. So is this a reflection of institutional positioning? And what does it tell us about the current appetite for long-term duration debt in East Africa?
Yeah, very right. So what we're seeing a more switching towards the end of the yield curve, where investors are trying to lock in higher rates for longer. And this is on the back of key developments that have been, that are coming to play this year. So the central bank in January began transitioning towards market-determined coupon. And this is in a bid to be able to benchmark market rates with where yields are at the moment. So as a result of that, we're seeing more inflows into fixed income securities. And when you look at the primary auctions as well, there's been huge appetite for 20 and 25-year bond. Just to throw data out there, in the last 20-year auction, investors tendered a total of 760 billion, which has been a historical high. And the previous 25-year Treasury bond auction, investors tendered a total of 790 billion. So these two auctions have been historical highs. It's never happened before in a primary auction to receive bids north of 700 billion.
Well, that's all from our end. It's back to you, Karaba.
Very insightful conversations. Thank you for that update, Abby. Well, down south this week, the Africa Finance Corporation launched the State of Africa's Infrastructure Report 2025 under the theme Mobilizing Domestic Capital. This year's report explores how Africa can unlock trillions in domestic capital to transform sectors like energy, transport and logistics. For more, Samaila Zubairu, who's the president and CEO of Africa Finance Corporation, spoke to CNBC Africa's Nastasia Arens.
We've always advocated for, I would say, African ownership of our development. And that development has to be funded by Africans themselves. So it's very important that we demonstrate what is possible to fund this. So our research this year looked at, our traditional themes in energy, transport and logistics, natural resources, and industry, but we wanted to draw attention to the domestic pools of capital that we have on the continent. And our research indicated that we have about $4 trillion of domestic capital pools that could be available for our development. the large chunk of that, over $2.5 trillion, is in banking assets, which is not really available per se because it's a highly regulated sector, and with all the capital charge for long-dated instruments, it means investments in infrastructure and industry will not be as I would say, as easy. However, there is $1.1 trillion in non-banking assets or capital pools, such as pension funds with over 450 billion, public development banks that comprises institutions like ourselves, over 220 billion, insurance assets over 300 billion, and sovereign wealth funds over $130 billion. So these are the areas that we think we need to find a way to target. What's interesting is that less than 2% of that is invested in infrastructure, which is where I think the work needs to happen. And we need to direct, I would say, regulatory reform, to ensure that we have asset allocation for infrastructure. And also we have incentives for investment in infrastructure. Because, in some countries, the investment in government securities is up to 100%. In those same countries, or in some countries, you have up to 10% investment in alternatives. But in some countries, like Nigeria, you have specific allocation for infrastructure private equity, which is essential because, the talk is that you don't have bankable projects in Africa. And to create bankable projects, you need to invest in project development, project preparation, and it's equity capital that is typically used for that. So it's important for us to address this challenge of project preparation to create asset allocation to support that. And of course, we have infrastructure bonds, I think up to 15%. And then you have general private equity and venture capital for 5%. So allocations like this, help drive change. Why? Because if people know that there's capital allocated, then you would find, asset managers or professionals that are specialized in financial intermediation, come in and look at how they can build the right instruments that would channel the flow of funds from the savings to the products. At AFC, we have done this ourselves. We have created InfraCredit, which is a credit enhancement or credit guarantee, program for pension funds to invest in local currency in long duration assets. So typically most of the investments on the continent are short term. And you need to create instruments for long-term investments. So InfraCredit is an example of that. It has been successful. And at the report launched today, the CEO mentioned that they've had no defaults. And in fact, some of the pension funds are now investing directly into the assets, and that's the experience that we also see.
After a sluggish start to the year, the SA REIT sector has notched up 2 strong months in a row, outperforming both equities and bonds in May. To unpack what's behind the renewed confidence in the property sector and where to build opportunity in your portfolio, CNBC Africa's Fifi Peters spoke to Ian Anderson, who is the head of listed property at Merchant West Investments.
I think there's no doubt that lower interest rates or the prospect of lower interest rates has had a very positive impact on sentiment towards the sector. It's beneficial in that it increases the value of the property investments themselves because you are using a lower discount rate in order to value properties. These are geared investments, and so lower interest rates means lower borrowing costs, lower costs to the business. So that's all positive. But I think the biggest driver, and the one I think that has really allowed the sector to deliver these very strong returns in April and May, is this ongoing recovery in property fundamentals in South Africa. Obviously, there's some sectors that are coming off a very, very low base, like the office market. But pretty much all of the companies that have reported results over the last 3 or 4 weeks have all, and with almost without exception, the management teams have pointed towards improving fundamentals, property fundamentals in South Africa. And because of that, most companies are now forecasting reasonably good growth in distributable income for the remainder of this year and into 2026.
What do you mean then, perhaps more color around fundamentals and how that picture of improvement has played out in the office sector, across the malls, in some of the industrial property sectors? If you can just give us that understanding.
Yeah, so I think one of the biggest drivers has just been the lack of new properties. You know, the construction numbers, building plans passed, you know, building plans completed, those are at record low levels. So there's just no new supply coming on stream. That means that if you do just have a little bit of extra demand, you know, you start to fill vacant space, and we've seen that certainly in the office market, but it's happening across all of the property types. As you fill that vacant space and the demand starts to creep up, you can then start to charge higher rentals. So the big negative reversions that many of these property companies were having to absorb, you know, when they renewed a lease or they signed a new lease, you know, in some instances they were having to reduce the rental by 25 to 30%. Those negative reversions are now a thing of the past for most companies. Obviously, there are still very long tenure leases that were signed pre-pandemic that have been escalating at 7 or 8% a year. There will still be a negative reversion when that lease is renewed. But the number of those leases is very low now, and the impact across the sector is low. So most companies are now talking about positive reversions in lease renewals or new leases that are signed. So we're seeing revenue grow. You know, the big issue for a lot of the sectors still, though, is that operating costs are growing faster than revenue. But importantly, you know, the revenue growth rate is now starting to catch up to that the growth in operating costs, and so we are starting to see growth in net operating income. As I've mentioned, we also get lower interest rates, and so that all just filters down to the bottom line. And looking at a company like Equitas, for example, they've upped their guidance for distributable income growth for financial 2026 to between 5 and 7%. Now, these numbers, we haven't seen these sorts of numbers for a very long time, and I think that's what's driving the sector higher. It's just lower vacancy rates, filling space, growth in market rentals, positive reversions, all of these things are, and it's happening across all property types. As I said, though, it's most pronounced in the office market, because I'm not even sure what lower than rock bottom is, but that's where the office market was sort of 3 or 4 years ago, and we're now starting to see signs of life. Maybe not in every geography, like the Western Cape, for example, is doing incredibly well, but maybe not so much in Gauteng and KZN.
And those were some of the stories making headlines down south this week. This is where we draw the curtains on this episode. Thank you so much for joining us on Africa Business Weekly. You can, of course, catch all these stories and more on our website, cnbcafrica.com. But until then, stay watching CNBC Africa. I'm Karabo Mashaba.